Sir, and I guess Kaustuv wanted to join.
I sent the link. No? You, yeah.
Yeah.
So your floating rate note makes semi-annual interest payment and has a coupon rate equal to 6 months market reference rate plus 45 basis points. So that means it's a semi-annual bond. Coupon rate equal to 6 months reference. Plus 45 basis points. The interest rates are made in June and December. Okay.
So we just have to calculate like forward exchange rate kind of thing, right?
If the 6 months reference rate was for June, it is 1.95 percentage. For December, it is 2.25 percentage of the same year. The coupon rate paid in December, you will pay June's rate 1.95. So 1.95 plus 45 basis point. Just add up. 1.95 plus 45 basis points.
Yeah. 2.4.
That's it.
Okay. Yeah, got it. It was similar only.
Yeah.
I'll just share the screen. So over here, in this one, I got the right answer. Like which of the following does not depend on market discount rate? A bond's full price. But it was just like a fluke. Like, can you explain it? Like,
See, accrued interest is calculated based on the face value, not based on the market rate, right? Whatever company said on that basis. Clean price or full price includes what? IY.
1 minute. Market discount rate. That is the IVA. So a bond's full price. Still didn't understand. Just can you explain it?
See, when you calculate flat price, clean price, it is calculated based on IY, correct? Present value is calculated based on IY.
Yeah.
So that means market discount rate it is dependent on.
Yeah.
But the accrued interest is not dependent, right? Accrued interest means what? If the company says I will pay 10% coupon. So coupon is calculated on the face value, irrespective of whatever be the market rate.
Okay. Interest. It is a coupon rate. That's why.
Yeah.
Okay. Okay. Yeah. This one.
A credit card receivable asset-backed security most likely reinvest principal repayment during lockout period, because they will credit card, see, somebody will pay sooner immediately, somebody will not, somebody will convert it into EMI. So they would have promised that we will pay you after so and so date. Okay, let's say for example semi-annually. So somebody who is prepaying immediately, then what to do with that money? So they tend to reinvest.
Yeah. Okay. So lockout period means
Lock-in period.
okay,
Lock-in period means, before which they will not pay the interest. So they will say like, I will pay you interest only after 1 year.
yeah.
So till that 1 year it is locked out.
Okay, understood. Uh, this one.
An analyst gathers the following spot and forward. 2 year spot rate, 4 year spot rate, 4 year spot rate 2 years from today. The 2 years forward rate 4 years from today is
Is it a correct question? I was just not able to process it only.
okay. No, question is correct only.
Like we need 6 years, right? 6 years portrait and 6 years portrait and 4 years portrait we require, right? In this one.
Wait, I'll do this. 2 year spot rate. 4 year spot rate. Uh, 4 year forward rate 2 years from today, 3%. 4 year forward rate 2 years from today. Four-year forward rate 2 years from today. So after 2 years, this is 3%. Now the question is 2 year forward rate 4 years from today. This is the question. So how do we calculate now? No, we have to calculate 4 year forward rate. Acha, 2 years from today. Huh? 4 year
Yeah.
forward rate 2 years from today is here, na? 2 years from today. This
Okay.
this this one we have to calculate. 4 year forward rate 2 years from today.
2 year
Okay.
forward rate 4 years from today.
4 year forward rate 2 years from today.
No. 2 year forward rate 4 years from today we have to calculate.
No. Acha. Okay. 2 year. Okay, let me read the question again. 4 year forward rate 2 year. Okay, this is acha, okay. This is the given condition. Two-year forward rate 4 year from today. So this part we need to calculate. Okay. So I can find out 6 year spot rate based on all this. I have 4 year spot rate already. That's it.
Okay. I even I thought from this perspective, like we had to do this, but I was not able to solve it only. Like
So 6 year spot rate is what? 1 plus 1 percentage into 1 plus 1 percentage into 1 plus 3 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 percentage
I took
raised to 1 by 6 minus 1. Calculate.
I took like 1%, 1%, 2.5%, 2.5%. Then I took 3%, 3% when I was calculating.
No, no. Do now. This is geometric mean.
Okay.
Geometric mean only we have to do.
Yeah. 2.3289.
2.3289 percentage.
Yeah.
So now after 4 year for 2 years is equal to 1 plus 2.3289 percentage for 6 years divided by 1 plus 2.5 percentage for 4 years minus 1. I will not do raised to 1 by 2 because I want it for both the years.
Hmm.
Now you calculate.
Nine 9.28%. 1 minute. Yeah, I have to.
Now, Acha, this is per year. You have to do raised to 1 by 2 also. Then
So we have to do first 1 divided by 2 minus 1, or like minus 1 then
at the
1.
end only you have to do minus 1.
Okay. So I'll just have to redo it. 4.23.
Hmm.
Mm,
Then how you check the answer?
No, it is coming wrong for me.
Okay, show the answer then.
I'll have to search for it. I don't have the complete answer. I'll share it with you. 1 minute. Yes, sir. I shared with you the answer.
Okay, in WhatsApp you have sent.
Yeah.
Answer is coming as 2% for
Yeah.
them. Now, steps all are fine only.
I guess we did the same only.
Yeah, just that you have done some calculation error then. All fine only. That is, it's not a theory now where I have to doubt. So some
Yeah.
only. It's a clear thing.
Yeah. So like I understood the step.
Uh,
I'll do it by myself. But
uh,
just explain over here in the sum that we solved. So why are we taking like 1%, and then all three only? Like in the first step.
uh, okay. See the one. It says 2 year spot rate is 1%,
Yeah.
and 4 year spot rate is 2.5. And then 4 year forward rate 2 years from today is 7%. So that not 7, 3%. So that 3, 3, 3, all these are forward rates. 4 year forward, 2 years from today.
Okay, yeah, understood. That will give us the 3 year spot rate, and then
That 3 years, where is 3 year spot rate?
sorry, 6 year spot rate. Yeah, that
Ha,
will.
ha.
Yeah. Okay, now I understood.
It is all correct only what we have done. You have done some
So,
calculation error.
so will they ask this kind of thing in exam, like this big kind of thing?
It will not take time if you properly dedicate and sit and practice.
Okay, so I'll practice it. I'll share the screen.
Mhm.
So this is kind of the same thing, right? This should I learn it? This kind of things.
A bond issuer has a credit rating of triple B based only on this information. The rating of a senior secured bond. This is straightforward. Sometime back I told you, no?
Yeah, that only.
Uh,
But
uh, uh.
I find it tough to memorize these kind of things.
No, if you're finding tough, you ignore it. As I told you, like, before also, like, now your job is to retain, not to take more.
yeah,
Whatever
that
you cannot, you leave it.
I've actually skipped only this kind of thing.
Mm.
Like I understand the thing, but it is like memorizing is kind of tough for me.
Mhm.
Yeah.
The
This
worst yield to. So you have to calculate YTM and then yield to uh, first call and yield to second call, and whichever is the lowest, that you have to select as the yield to worst.
I know that thing, but even like we in the theory it was like uh, that yield to maturity is always the yield to worst only.
No, not necessary. You have to calculate and then find out.
I guess I read it somewhere like yield to maturity is like the yield to worst.
No, it depends upon at what rate other call options are being exercised, right?
Yeah,
Call rate will change.
like first call always gives the highest one, like, and then the call price at the second year gives a lesser than that, and the final one is like the least paid.
Mm-hmm.
So like I thought like that only we had to do yield to worst.
Mm-hmm.
So I chose like yield to maturity.
No, you have to literally calculate and check.
Okay.
Mm.
So we have to calculate IY and then
Yeah, every time you have to calculate. Yeah, similar sum it is there in the book also. You can
yeah
refer
that
again.
yeah that only I thought about it like
Mm.
that. Okay. Yeah, this one. So it was like uh, the bond with lowest Macaulay duration.
Mm.
I chose like 1 minute. What answer did I choose? Yeah, I chose C.
Mm.
But it was like uh, because yeah, it was like bond 3 had a coupon rate and YTM of uh, YTM of 5. So I chose 9. Like it
Mm.
has the because it is like a zero coupon bond, right? Not
Mm.
zero coupon.
Mm.
It is like a par bond. So I just chose 9.
Mm.
But is there anything like without solving we can find out?
The bond with the lowest Macaulay duration. Uh, Wherever the present value is lowest, an analyst gathers the following information about three option bonds, each trading at a premium. Okay, all three are trading at a premium, but we don't know the exact premium. or else being equal the bond with the lowest Macaulay duration. Uh, 10 years. You have done what lengthy method, proper formula.
I didn't do anything. I just saw that bond 1 is par and bond 3 is at par. And time to maturity is 10 and 9. So I just thought like I chose 9, but I didn't solve anything. It was just like I took a bet kind of.
Where is it mentioned it is par value?
Coupon yield and yield
It's
to
trading at premium, right?
no. Bond 1 has coupon yield of 4% and time to yield to maturity of 4. So it is at par only.
Okay. See, at the top it says an analyst gathers the following information about three option-free bonds, each trading at a premium.
But it is like coupon yield and yield to maturity is like same only. So it is par only. For zero coupon bond, the time to maturity is only the uh,
Macaulay
Macaulay.
duration. Yeah, yeah.
But I just thought that if it is like a coupon yield and yield to maturity is same, then what should it be like without solving? Like kind of
No, we cannot. There is no such rule. If it is trading at par, okay, still there is no such rule. It will be lower than maturity. That much only we can say.
but like I was thinking that if we go for solving, then it will take a lot of time. So I
That,
just thought
that is just for practice sake here. They have given. You will not get like so lengthy in the exam.
I took a fluke by choosing bond 3 and I got it right.
Mm,
Let me check if I picked the answer.
mm,
I should I share the answer for this?
okay then. Yeah.
I'll share the answer because I just took it as a fluke because I just thought that I will not go to solve this because it will take a time. Like so I just took a fluke and just chose it.
Mm.
Yes, sir, I've shared it.
Mm.
So they are saying that higher time to maturity always decreases Macaulay duration.
A
So
higher coupon rate or higher yield to maturity reduces duration measures. The longer time to maturity usually leads to higher duration. It always does so for your bond priced at premium or at par value. In this case, bond 3 has a higher coupon, same or higher yield to maturity, and the shorter time to maturity is therefore is the lowest. Higher coupon, shorter time to maturity. Mm.
so it is like because bond has higher coupon rate and yield to maturity
Mm.
and lower time to maturity. So it has the least Macaulay duration
Yeah. At
because
the top, they said it is trading at premium, but that is a wrong statement.
yeah.
Uh, I mean, ideally, it should not be trading at premium.
So like if this kind of statements are they are making like
Mm, mm,
H is trading at a premium, which is a
mm,
wrong statement from
mm,
their end. So will they give us a free marks or anything kind of this? Like
No, we don't know only about all those things because that is what they have properly measured that nobody should speak anything about CFA.
yeah,
Correct. So nobody speaks openly about CFA. Nobody dares to criticize us.
okay. So like I
Mm,
chose bond 3 by just by a fluke only.
mm.
So I got it right, but now we got to know like about how to choose the correct option like based on this. That higher coupon rate, higher yield to maturity, and lower time to maturity brings down Macaulay duration.
Yeah.
So is it the same for modified duration?
Yes. Yeah. Because
Even
Macaulay duration is only converted into modified duration. Na?
so
Divided by 1 plus n.
higher coupon, higher maturity, lower higher yield, and lower maturity also reduces a modified duration. So I'll just note down the statement.
Mm.
Yes, sir.
Mm.
This one.
Which of the following mortgage features most likely benefits the lender? Benefits the lender.
I chose B.
Which of the following mortgage features most likely benefits the lender? Non-recourse loan, prepayment option, prepayment penalty. Yeah, straightforward. Non-recourse loan will benefit the investor, right? No. Uh, Most likely
Will
non-recourse.
cost,
Recourse.
it will
Which are the
benefit.
following? Yeah,
No,
non-recourse loan, okay, but penalty will benefit the maximum prepayment penalty.
I thought like the earlier the money is retrieved, it is better, like prepayment option. So can you explain why prepayment doesn't benefit the lender? Like if the money is coming back early, then it should be.
The interest they are losing. No?
But like I just thought like it is like If I give you my money, then it is better that you repay me again. So I just thought from that perspective.
No, the purpose is you want to take maximum interest.
Yeah. I didn't even read it, so I just chose on based on the options only. I have not read that chapter.
Mhm.
This one.
With respect to the notching process adopted by credit rating agencies, a corporate's subordinated debt is most likely subject to smaller notching adjustments the higher the corporate issuer rating. With respect to the notching process adopted by the credit rating, subordinated debt is most likely to be notched up from the corporate's junior subordinated debt, notched down from the corporate issuer's rating due to higher probability of debt default.
Sir, in which chapter this thing is present? Like
The last one.
last, yeah,
With
I'm not.
respect to the notching process adopted by credit rating agency here, corporate subordinated debt is most likely more notched up from the corporate's junior subordinated debt. Corporate subordinated debt is most likely subject to smaller notching adjustments the higher the corporate issue rating. Subject to smaller notching adjustment. The rating agency adopted a notching procedure where the credit rating on issues can be moved up and down. Usually the rating applied to its senior side can. Yeah, the corporate seven is most likely. Yeah, see, more the rating is, the changes will be less. Mm. If the rating is very strong, see, from double, what do you think? From triple B to double B, if it comes, the change will in the bond price will happen more, or from triple A to double A.
I like. I don't remember the
See,
rating.
triple B to double B. Double B is what? Junk. So from
Okay.
triple B, it comes to junk B, junk bond. The change will be massive in the bond.
Yeah.
But then triple A to double A is still fine.
Yeah.
That's what it means.
Okay. So like I've not read it. So can you just explain each and every point, like each and every options to me?
No, no. Otherwise, you leave this one fine, because this again you will not get the satisfaction then.
No, like I'm not. I was reading that subject
Hmm.
whenever I was reading, so I was not able to process all the things. So like I just skipped that last two subject chapters.
No, that's why
So
I'm saying
I
now.
just
Now it
thought
is.
that like from only questions, whatever things comes in questions, I'll just remember that.
See, for example, inflation. Now,
Yeah,
whom will inflation affect highly? Is it for rich people or is it for poor people?
poor.
So, poor rated bond will affect more.
Yeah.
So, rich rated bonds will not be affected highly. So, that's
Okay.
what it means. So, smaller change now for a rich bond.
Mm.
So,
Yeah.
which whose rating is already low, that will be affected highly.
Mm.
So, higher bond, smaller changes only will happen.
Yeah. And what does A and C point means?
No, those are all wrong statement. Don't go for that one. This is, see, now you are learning, right? This one. Now you stick to this point first.
Okay.
Then next time when you read, because these are all the areas where you are saying like it is not going into your head. Now when
Okay.
it is not going to your head, you should not try to read A to Z all in one go.
Yeah.
Take the point that you can take. Then another day you sit, because by that time something has gone into your head.
Yeah.
Then that remaining something will go into your head.
Yeah. That
Then
only
another
thing
day,
I'm trying to do. Yeah.
huh, Otherwise, if you sit and say like, I want to read everything all in one go, then you will get more confusions only.
Yeah, that only
Mm,
thing right
mm,
now, even I was reading
mm,
economics,
mm,
I was doing that only. Like there were around 6 points, out of which two, 3 points I was able to understand, and two, three I just thought that let you only explain. Like those
mm.
were small points only, but it's
So that
better
you
that
can ignore, Vinay. That's why I'm saying. Now, see, now more and more you try to jump into those areas which you don't know. More and more you are going to forget what you know.
that kind of points are like I would remember only those were easy only, but it was just that if you explain that will go into my head much more better way than me trying to explain myself. That I thought like those were small points only, like not something like big, but those were kind of important. Like uh, so I just thought that let you only explain. Like if I
Mm.
try, then it will be just a waste of time only. I just thought that more questions that I solve that will only be better for me. This
Mm.
one,
Money market yields are annualized and compounded, stated for a common periodicity, stated on a simple interest basis. This is, remember, we did bond equivalent yield, money market yield, bond bank discount yield.
yeah.
So in money market yield, we were using simple interest rates only, no? Proportionately only it was moving up and down, not compounded.
Okay,
Annualized and compounded is equivalent annual yield.
so for long maturity bonds, is it annualized and compounded?
Yes, yes.
Okay. I just thought from that perspective, like, and I chose A.
Hmm.
Now I understood. Just like in economics that we do.
Hmm.
Okay. So these questions are over for me.
Hmm.
This was the practice pack.
Hmm.
Now I just have few questions from here. This uh, website questions. I'll just share it with you.
Hmm.
Those are not many questions. I just share it.
Yeah, hello.
Yes, sir. 1 minute. I'm just searching for that. Yeah, I shared it.
Hmm. Suppose the 1 year and 2 year spot rate in Canada move upward by 20 basis points. but the 3-year Canadian spot rate remains unchanged. Which of the following best reflects the updated 3-year Canadian?
So we have to do the simple one, right? Forward and spot exchange rate calculation.
Suppose 1-year and 2-year spot rate in Canada. So you just scroll up first of all. Wait.
Yeah, I guess we did this.
We
Yeah,
did this, yeah. That's
yeah,
what
yeah.
I
We
mean.
did. So this, not this. Yeah, after that, hold on. 1 minute. Wait a second. Have they changed the questions?
No.
1 minute. I'm not able to find that. I'll just share it with you
Hmm.
on WhatsApp.
Hmm.
So I have sent my couple of doubts.
Okay, okay. Yeah, both are very similar only. No? Yeah. Okay. Shall I, in the meanwhile, I'll just sort out his doubt.
Yes, sir.
You can see the screen, right?
Yes, sir.
See, first one, a 2-year floating rate note issued by a French corporation pays the 3-month MRR of minus 0.55 percentage plus 160 basis points. The floater is priced at 101.20 per $100 of par value, assuming 30 by 360 day count convention and 90 days per period. The discount margin for the floater is what kind? Where is this Schwezer question? Where did you get this question?
Yes, a website question.
It is in the website only. Okay. Uh, so this is for how many years? 2 year. So 2 year semi-annual bond, right? No, quarterly, 3-month MRR,
Really, yes.
quarterly bond. Okay, so 2-year quarterly means 4 into 2, 8. Then interest rates coupon will be minus 0.55 percentage plus 1.6%. How much is this coming to?
1.05%.
1.05% coupon. Okay, so 1.05 divided by 4. Calculate.
0.2625.
Okay, percentage, correct?
Yes, sir.
Okay, so 0.2625 is the payment, 100 is the future value. And then IY and present value. IY present value is 101.20. Now you calculate IY and whatever you get, multiply by 4.
0.4, 0.447.
You multiplied by 4.
Yeah.
Okay, so this is the IY. Now the question is, what is the discount margin? So discount margin means, see, IY is equal to MRR plus discount margin. So MRR is minus 0.55%. Discount margin IY is 0.447%. So X is equal to 0.447% plus 0.55%. Just calculate.
0.997.
That is discount margin. So that is not matching.
So the answer is 50 basis point, 0.5%.
50 basis. Okay, where is the explanation? Actually, explanation is also there.
So they are getting answer is 0.1241 and I am getting 0.111.
Okay. So 0.124161 into 4 is equal to minus 0.005 plus discount margin. Multiply this one.
Sir, I guess the answer in the website is only wrong regarding.
Wrong. Yeah. That's what I'm going
You
to
can
prove now.
recheck this thing.
Yeah. We have done this kind of questions. Yeah.
0.4966.
Now discount margin is equal to 0.4966 plus 0.005. Let's calculate.
0.50.
Okay. So now this number, okay, this calculation is right. Now this number 12, okay. Present value, this is right. This is okay. 0.2, see, this is the problem. They mentioned 0.275. That is the wrong number. Understood? In that answer, can you see?
Yes, yeah.
So that is wrong. The question is, the answer solution is wrong. So let me go by their way. If I take 0.275, now you take IY. This number they have mentioned incorrect.
So the IVA should be multiplied by 4.
Multiply by 4.
So now it is coming 50 basis point.
Okay, so actually this is wrong. They wrong means it's a printing error, and on that basis they just calculated. Somebody must have lost the focus and some human error happened. But the method is all correct only.
But even if I asked the ChatGPT, it also gave the same answer, 50 basis points.
But on what basis? You should ask now whether why this is, how come it is 0.275?
Yes, I blame the calculator for it.
Blame the calculator means, what does that mean? Whether
So it said that,
0.275 is right or 0.2625 is right?
no, the 0.2625 is correct, but the I don't know, the ChatGPT also got the answer as 0.124167.
Then that means that's why this is wrong. Now what they have done is wrong. That's a human error that has happened. Okay.
So what would have been the correct answer then?
What we have done, that is the right answer. Whatever we have done. See, because this 2625 is the right number.
Yes.
By mistake, they wrote it as 0.275. And from there, they calculated everything.
Okay, sir, understood.
Okay, then next doubt. Again, next is also similar only. I'll just quickly do that one. See. DMT Corp issued a 5-year floating quarterly. Quarterly means 4 into 5, 20. Then 3-month reference rate, okay. MRR plus 125 basis points. So coupon is MRR plus 125 basis points. And what is the MRR? FRN is priced at 96. This is 100. MRR is 5%. MRR is 5 plus 1.25. This becomes 6.25 divided by 4. Just calculate this. 4 because it is quarterly.
1.5625.
So 1.5625. Now you calculate IY, multiply by 4.
$7.21.
7.21%, right? After multiplying by 4.
Yes.
So 7.21 is the IY. Now the question is, the discount margin is what? So discount margin is, see, IY is made up of 2 components. MRR plus discount margin. Just like coupon is made up of MRR plus, this is called quoted margin. Okay, IY is made up of MRR plus discount margin. So MRR is 5% plus discount margin. IY is 7.21%.
Yes.
Now you just have to shuffle this one.
Yeah.
Is it okay?
Yes, sir.
Yeah, any other doubts you have?
It is just one only single easy doubt I'll just send you.
Okay. When compared with an option-free bond, which type of bond most likely offers a higher yield? It will be
Is it only
callable.
because of the risk that they are the investor are willing to take because of the callable, because
Yes.
of the embedded option?
Yes, see, callable is favoring the company. So that's why company has to offer more to the investors. Puttable is already favoring the investors. So why will they pay more interest then?
And what about convertible?
Convertible is also favoring the investors, right? If it is favorable, you convert. So why should they offer more? It is an additional option given to you, right?
So the puttable and convertible will have less yield than normal bond.
Yeah.
So, okay. Understood, sir.
Okay. Yeah. Okay, Vineet, now what are your doubts?
Yes, sir, I'll share it. So this, we did it, but just can you explain it again? Like,
Which are match the following statement about forward rate curve. The forward rate curve. Okay.
so you had made us memorize just few points, but I guess this was not covered in that points. Like in textbook, it was not covered.
The, the forward rate. The forward rate curve. Okay. The forward rate curve is okay. Kaustubh, if you want, you take the screenshot of that question. Then when I will explain, you can keep checking what I'm doing.
So which one?
The question that he is showing. So share it again.
Yeah, ये वाला.
Okay, I'm okay with it. I got understood it.
Achha, okay, then okay. Okay. So you take one simple example here. Okay. Here, 1 year rate is 5%, and the forward rate is, let's say, 6-7%. What is the spot rate now? Approximately, it will be 6%.
Yeah,
So that means when the forward rate is ahead, okay, when the forward rate, now you see the first one, the forward rate curve lies above the spot rate curve.
yeah.
Then that time the spot rate uh, uh, the spot rate curve is
The forward rate curve
the
lies up.
forward rate curves above. So this is the case. Okay, this is the forward rate curve.
Yeah.
That means this is more than 6%. This is 6 and this is 7%.
Hmm.
The spot curve is downward sloping. Comparatively, it is not above forward. Okay. Then second one, the
One
forward
minute.
rate.
Uh, so the forward rate curve lies above the spot rate curve.
Ha.
So
Suppose
so answer for it is the spot rate curve is upward sloping.
the spot rate is upward. No, forward is upward sloping. When forward is upward sloping, that's why the
The
uh,
answer is B for it.
the spot the forward rate curve lies above the spot rate. Forward rate curve lies above the spot rate. The spot rate curve is downward sloping. The spot rate curve is upward sloping. That is normal. That is normal. This is what it is supposed to be.
Yeah, it is
Okay.
lying. It is upward sloping. That
Huh.
means.
Huh. Then the forward rate curve lies below the spot rate curve. So that example will be 5% and 3%. Now what is the spot rate? This is forward rate.
It is 4. It is
4
downward sloping.
4%, 4%. Now it is downward sloping. Spot is downward sloping. And when spot is downward sloping, that's why the forward is also downward. Okay, so in this case, it will be like this 4%. This is spot and this is forward.
Now I understood.
Forward is lower. This is 3% and this is 4%. And both are equal. So both are equal means
Yeah, it is same.
same. Yeah.
Yeah, now I understood it.
Okay.
Yeah. Uh, sure.
Mm.
This one.
The par rate curve lies above the spot rate. The par rate curve lies below the spot rate. The par rate curve is equivalent to the spot rate curve. Okay, the spot rate curve is upward sloping, normal, and spot rates are negative. The spot rate curve is downward sloping, normal, and spot rates are positive. Spot rate curve is flat across all maturities. So for 3 it is C. Right? Both are equivalent. Okay, now between 1 and 2. The par rate curve lies above. See, you remember we have done spot rate that Z1 minus Z3 divided by Z1 plus Z2 plus Z3.
Yeah.
Okay, now that time, and I'll share and explain. See, in that, remember, the par rate will be lower than the spot rate. Slightly, it will be lower than the spot rate.
But I don't remember that thing, I guess.
See, if I say 1 year, if I say 1 year spot rate is 5%, 2 year spot rate is 6%,
Yeah.
and 3 year spot rate is, let's say, 7 or 8%. Now, if I ask you to find out a 3 year par rate,
Yeah.
so you check later on, it will be close to 9, 7.7 or 8, 9, something like this, 7.8% around.
So it will be above about 2 years spot rate and lower than 3 years spot rate.
It will be close to the last one directly.
Okay, close to the last
Last
one.
one, yeah. But
Okay.
now in this case, spot rate is going up.
Yeah.
Okay, so this par rate is lower than the spot rate. Okay, so this will be second one you read. Par rate curve lies below the spot rate when the spot rate curve is upward sloping. So second's answer is B,
Okay.
because here you see it is upward sloping and par rate is below the spot rate. And then par rate curve lies above the spot rate and is up when spot rates are negative. Okay, spot rates are negative. Okay,
Okay.
upward, but spot rates are negative. So that means it should be like this:
Yeah.
-5. It is the opposite one. No? So -4 and -3%. It is upward sloping now, right?
Yeah.
Now in this case, it is the opposite. The par rate will be more. It will not be close to 3.
So it will be -2 or something
It
between.
lies above. It lies above. That means -2. Yeah, correct. -2.
So it is more than spot rate curve.
Yeah.
Okay. Now I understood. So is this thing in the textbook? Is it given in textbook?
Textbook, I don't think so. It is given. It is
Yeah.
not given.
You made us write few points, but it was like
I just
discussion.
normally tell people that spot rate, par rate lies close to the, or it is little lower than the spot rate. If it is not, you have done a mistake.
Yeah,
Normally, I tell this.
yeah. Okay, now I understood this thing. We tried it earlier, but it was like it was too soon for me to understand that at that time.
Mm-hmm.
Now I understand.
This one.
No, no. This one. So uh, over here, just can we once solve this thing? Like it will just help me to. This is Macaulay duration only. So like, can you just explain me if it is like on semi-annually and that thing? So how can we solve it?
Mm-hmm.
It is not necessary to solve the entire thing, but just the process of it.
Mm-hmm. Okay.
Because like in this case, like even if minute mistake we make, then it is like a big headache for us. Like
Mm-hmm. So the formula is Macaulay duration is equal to present value of individual cash flow divided by present value of total cash flow into time period, number of time period. So present value, consider a bond that has 3 years remaining to maturity. Okay, but semi-annual. Oh, okay,
semi-annual.
semi-annual.
It is not necessary that you take the same sum, like just like semi-annual basis, like just anyone.
Mm, okay. Assuming, so what is the coupon? Coupon is 4%. 4% of 100. 100 is 4. So it will be 2, 2, 2, 2,
So
2, 2.
coupon we have to take two, and yeah, that is like one memory thing that to keep. Like
Okay. Now 1 plus IY is 4.6 percentage divided by 2 raised to. Now this only we have to calculate. It is 180 days because they said 30 by 360. So
yeah,
out of 180, 12 days are over. So 180 minus 12, you do 168, right? So 168 divided by 3, 180. Just calculate this.
1 minute. We don't have to do like that.
Hmm.
We can take directly, right?
Directly what?
Uh, like one number of periods, like
No, number of period is 1 now. This amount we have to calculate now, present value of individual cash flow.
yeah.
Hmm.
So can you explain why 168 divided by 180?
Because
Because
already
we are 12 days into the bond, that's why.
12 days are over, right?
Yeah.
12 days. See, it says assuming it is 12 days into the first coupon. Uh, that means you are standing here. You are not standing at 0. You are
Mm,
standing at the 12th day.
yeah.
Okay, and this is 180th day. This is 360th day. So that's why I'm discounting for 168 day.
But just like if you assume like not this question, just like it is a normal one. So we have to take one right over here.
Number of time period is 1 only. I'm not focusing on that one now. I'm
Not like
focusing on this one.
I'm not talking about this one. I'm
Mm.
just talking about like the normal sum,
It will be 1 only. First one, second one 2.
not
That
like
way.
0.5, right?
No, no.
Okay. And over here we don't have to divide it. Yeah, we have to divide it. But
Mm. See,
I
it is
get.
also I give you another tip. See, suppose let's say if this kind of question comes, what you can do is it is easier to calculate based on 0, right? Then it would have been directly raised to 1. You would have done.
Yeah.
Okay, and then this will be raised to 2. That way you would have done.
Yeah.
So now whatever answer you get, okay, all you have to do is, that means that is not the right answer, certainly.
Yeah.
Okay, so now because few days are already over, uh,
So something nearby.
yeah, something nearby, which should be, I'll tell you what, it should be lower or higher, because if you discount for 180 days, it will be even smaller. So smaller, all will be smaller. So yeah, you have to get little bit higher number, because you are discounting for smaller time period now, 168 days only.
Yeah.
So that also will work. You understood this now?
Yeah. And so later on, like after this entire step of calculating, then we have to then we have to multiply it with 0.5, right? The next step, whatever that would be.
Multiply with, this is 1. Time period is 1. You have to multiply with 1. Then next number you have to multiply with 2.
Not like that. I'm talking about this is the raised to thing, right? One. But I'm talking about the Macaulay duration. Like
Yeah,
after,
no, I'm saying Macaulay duration is, see, suppose this number is, assume this is 1.5, and you have added all, it is coming to maybe like 90 into 1, first one. Then second one is, assume this is something 1.3
yeah,
divided by 90 into 2. You will keep doing like this and you will add all.
yeah,
So this is 1, 2 only, like this it will go.
yeah,
See that 0.51 all will come only here in time, not in time period.
yeah,
So in this type of question, only the first period will have the raised to part, no? 168 divided by 80. Then all will go as usual. We have to discount, no?
Second one will be 1 plus 4.6 percentage divided by 2 raised to, see now this is little problematic one, because you have to do 360 minus 12, that one divided by 360.
Just can we solve it on the normal basis, like then only like it will be understandable.
See, normal basis is this is how many days now? 360 minus 12 you do. I have a video also. I think I have done no very simple case I have done. But now here, if you want to do 360 minus 12, you do how much?
348.
348. Similarly, this one will be 1 plus 4.6% divided by 2 raised to, now this will be 360 plus 180 you do.
540.
So out of 540, so this will be 540 minus 12 you do.
528.
So 528 divided by 360. It is just like, 2, 3, the number will increase, right?
Yeah.
Normal case. That way, now it is increasing now, 528 divided by 360.
Yeah. So sir, like after that, this then we have to use the weights. The weights
No,
thing.
that weight is only the number of time period.
Yeah. Okay. So like that will be 1, 2, 3, 4 again.
Ah,
And the final answer that we get, we have to multiply it with 2 or then
if it is semi-annual, yes, you have to multiply by 2. Yeah.
okay, so that only I just wanted to know.
Ah.
Okay, I'll share the screen now. So like the answer that we get, it will be half only. And we have to always use the number of periods, not the time period, right? Not like 0.
No, 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 no. See,
Okay,
I'm
so
just putting this video also in the group now.
it is
You can
semi-annual.
practice that. No, that is not for semi-annual one. That
I
is
just
simple
had
one.
a doubt regarding semi-annual only.
Ah, ah.
The normal thing I understood, yeah.
Okay.
Yes, it is.
The Macaulay duration in years for bond 1 is closest to bond 1 semi-annual
1 minute.
bond YTM. That much is only the question.
Yeah, so again, that only the same thing was that. Like I just had a
Is assessing the interest rate of 3 bonds. This also you have to calculate only manually.
yeah,
It is
that
for
was
how many years? All 3 bonds are issued on June 1, 26 and mature 4 years.
so
And it
that
is
only
annual only.
so that
Semi-annual. This is semi-annual.
that only I had just a doubt that in semi-annual, but like which one we have to take the time period and like that.
Mm-hmm.
So in final, we just have to multiply it.
Mm-hmm.
Yeah, this one.
Mm. Relative to a 5-year zero coupon bond priced to yield 5%. Bond 3 has a modified duration that is best described as relative to a 5-year zero coupon bond priced to yield 5%. Bond 3 has a modified duration that is best described as bond 3 is semi-annual 5% yield to maturity 5 relative to 5-year bond yield. Okay, it will have lower Macaulay duration will be lower.
So
It
like
will be lower.
just that 3 points that
Because you are getting money periodically, whereas zero coupon bond you are not going to get any money.
so bond 3 has a lower modified duration, right?
Yeah.
So the maturity is same only. Uh,
Yeah, but
yeah,
modified duration will be lower, right? Because in your coupon bond you are getting coupon. So that means, see, what is Macaulay duration? Weighted average time to receive the amount.
Yeah.
You are receiving the amount. In zero coupon bond, you are not even receiving the amount.
So like just the point that we have read, higher the coupon rate, higher the YTM, so the lower the Macaulay duration. So is this the same point?
Yeah, correct. Correct. Same only.
Yeah. This one.
Which of the following statement regarding Macaulay duration is correct? For a given coupon rate, Macaulay duration can be lower for a long-term discount bond than for a short. Yeah, long-term discount, you have to wait longer times. Wait, for a given coupon rate, Macaulay duration can be
Yeah, the
lower
same points.
for a long-term discount bond than for a short-term discount bond. If the coupon rate is okay, so here same coupon rate we are taking. So if it is same coupon rate,
Yeah, so yeah, this is based on like time period. So the
yeah,
long,
this is an exception. Macaulay duration statistics increases with your bond's time to maturity. Yeah, but here it is an exception where long-term coupon bonds duration is lower. It is an exception. Why it is an exception is this is more like out of the money contract. That means the bond has become so very poor that everybody is just dumping this bond. So in that case, the price will keep going down and down. So uh, that is why the Macaulay duration also will go down. Then this is an exceptional bond. That means out of the money bonds. That
yeah,
means it is like this: you are watching a match. Already it is now, it's very clear that within 1 over, 50 runs required. Now it's very clear that the match is going to be lost. Now the batsman is hitting six. Further, what will you conclude? That again it is going to lose. Second one, again he is hitting six. Again you are going to conclude that he is going to lose. That
yeah.
way. It is deep discount bond. They should have used the word deep discount bond. Okay.
So the same thing.
Hmm.
Yeah, this one.
Just 1 minute. Okay, 1 minute. This question.
Yeah, so it is kind of same only.
Hmm, hmm, hmm.
This is the new thing that we learned today. Like,
Hmm. Okay.
so, 1 minute.
Hmm.
Yeah, this question I got it.
The Macaulay duration for the FRN would be lower only, right? Because of the it resets periodically. That's why.
Macaulay duration for FRN, yeah, it will be lower. Yeah.
So this one.
The appropriate percentage. A bond with par value of $100 matures in 10 years with a coupon of 4.5 paid semi-annually. It is priced to yield a 5.83 and the modified duration 7.8 if the yield declines by 0.25 percentage. The approximate percentage. This is that percentage change in the change in bond price, that convexity.
Yeah, so
That
like
one.
1 minute.
Convexity is the formula.
Yeah.
Convexity will be 0.
1 minute.
So duration into change in YTM plus half of convexity into change in YTM square. Convexity is 0.
Yeah. Okay. Yeah, understood. I had a doubt earlier, like not. Um, mm, yeah, this one.
An analyst gathers the following information about an annual pay bond. Coupon rate, YTM, we call it duration. If the YTM decreases by 100 basis points, the expected percentage change. Again, same one.
Yeah. So like, so this is like, so this always gives us a percentage, right? Not like absolute price change, right?
No, but we can convert that into price if you want.
Yeah.
Okay.
So over here, convexity is not given. So
It is 0 convexity.
okay, so convexity we have to assume 0.
Yeah.
Okay. So how do we understand that convexity is assumed to be 0?
If nothing information is given, you cannot find out only. No?
Okay, can't we use direct modified duration for those things?
For those things means?
Like for these kind of questions that were like which didn't have convexity.
We
So
can use, convexity we will take as 0.
no, but then we used yield multiplied by modified duration. But instead of that, we can directly use modified duration only, right?
Modified duration into change in yield.
Not like just the modified duration.
No, change in yield you need to know, right? Otherwise, modified duration is indicating only directly for 1 percentage.
Okay. Okay, understood. Yeah. So I just had doubt like that.
Okay. You have more doubts?
Yeah, only few, two, three doubts. 1 minute. Yeah. That's fine.
This one?
Yeah, this one.
An investor's well-diversified portfolio of 2 lakh in cash. The investor aims to invest in short-term 1-year large-cap company bond prior to using the cash to invest in an upcoming IPO. Short-term 1-year large-cap company bonds prior to using cash to invest in an upcoming IPO. There are currently 2 large-cap company bonds on the market to purchase. There are currently 2 large-cap company bonds on the market. Currently 2 large-cap company bonds on the market to purchase. There are currently 2 large cap company bonds on the market to purchase. There are currently two large cap company on the market, large cap company bonds on the market to purchase, but with both with 1 year maturities. Okay, one of the bonds, bond A, is a non-callable bond, while bond B is a callable bond. As a fixed income analyst, you are asked to conduct an analysis. You are asked to conduct an analysis. A colleague asks whether you are also considering whether you also consider looking at the key rate duration when comparing interest rate risk of bond A and B. Would research into key rate duration for bond A and B help to make a decision better about the interest rate risk? Not really. Yeah, why? Because it is a short term, 1 year only.
But like, okay, so because it is like 1 year, so we don't have to check the
Yeah,
key rate.
yeah.
Okay, so just like I got tricked over here, like,
If this would have been long term, see what is key rate duration for different maturity. Here there is only one maturity, 1 year.
yeah. So like this entire big question was there, so like I thought, yes, it would be
The key word over there is 1 year maturity only.
okay.
Both are for 1 year, that third line.
Okay, yeah. So like, this
What impact would a flight to safety? Flight to safety means investing in US government bonds. That, when during anything bad happens, like COVID and all such things, people will run for safety. That is called flight to safety. So what will happen? What impact would a flight to safety have on the analytical duration estimate of bond A? Analytical means formula based. So formula wise, it is not impacted. Empirical only, the yield will come down. Formula based, it is no impact. Because why? Because we are following formula. It is just like risk neutral probability. Even if Trump speaks anything, risk neutral probability is not going to change. No?
yeah.
It is neutral to what is happening around.
Then there would be
Analytical means formula based.
an empirical, it is increased duration.
Changes will be high.
Okay. Uh, this one.
The investor's portfolio is diversified and the fixed income component of the portfolio has bonds of various maturities with a duration of 7.48. Okay. What would happen to the effective duration of the fixed income component of the investor's portfolio if bond A is added? Because it is highly diversified, it is not going to make much differences.
So can you explain this?
When it is highly diversified, each individual's contribution is negligible.
Yeah.
It is like you have 50 stocks. If one stock goes down, what will happen? Nothing will happen in your portfolio.
Yeah.
Because each individual's power is very less here.
Yeah.
And also in bond already, one bond's changes will be very less.
Okay. Okay, so
And you are adding one more. So it will be like, it will hardly make any difference. Yeah.
And so it is also because the new bond duration is same as the portfolio duration. That's why also.
More or less, it is going to be the same only. Yeah. Because it is diversified.
okay, so like understood. So my doubts are finished. So like, should I bring economics doubts or we'll do economics doubts later? Like,
Yeah. You can ask now, not a worry. Kaustubh, if you are getting bored, you may just disconnect. It's not a problem. Okay.
So it's fine. So I also have some FSA doubts also.
So you put up all the questions now.
So like
Yeah.
I'll leave then.
Mm,
Like I'll be giving tomorrow economics test
mm,
in the morning. So like afterwards, can you share me the questions?
yeah,
Okay.
yeah.
Yeah. So I'll leave.
Okay. Huh. Yes, you may ask now.
Yes, just a minute.
Huh.
Also, can we do it later because I'm only halfway through the questions.
Okay, okay, no problem. Okay then.
So I just wanted to ask the question that I've done my fixed income website question.
Mm,
So I
mm.
just got 70 to 80%. So should I start with the questions that you will give, or I should actually complete the whole website questions?
No, I would say complete the whole website question.
Not
Uh,
as in every
or
subject.
yeah, every subject. And in between, you keep coming back to the website questions again and again, what you have already finished. At the end, if you come to practice pack, it is a better one. Otherwise, also when you are giving practice pack, you should give like 2 3 subjects together, because you should get the pressure of 180 questions.
Yes, sir.
Okay, otherwise I will give you only one. Now, fixed income. Number one, you don't have then much pressure. You are giving only one subject. So that means the output is not very clear then. You will get good score. We will be happy. But during the exam, you will get, scared then. That is number one. Number two, you know, uh, that, now everything is fresh in your mind. Only one subject you are giving the test. So it will give you a very wrong picture, that, okay, I will also think that, oh, everything is going correct. You will also think everything is going correct. But at the end, you don't have the practice of then writing all 10 subjects together.
Yeah. So,
That's why now, because you have more questions, you follow that one only.
so it will take me a month or so to complete all the curriculum website question. I mean.
You have ample of time. See, that is, anyways, you are giving in Feb only, right?
Yes, sir.
So you take your time. There, for you, there is no time constraint as such, right? But whatever you are doing, do it more accurately, thinking from long-term perspective. That way you do it. Accuracy is more important for you now that you have ample of time.
Yes, sir. So
Okay.
now I've done with my fixed income. So I'm halfway through my FSA. So which subject should I do next?
Go for high weighted subjects if your mind is, okay to take high weighted, like quants or tough one. Go for quants.
Okay, so yeah, I will
Hmm.
go for phone.
Hmm.
Okay, so
Okay.
then are we
Okay.
keeping
Yeah.
session on Wednesday?
Huh?
Are we keeping session on Wednesday?
Wednesday. See, I'm thinking. Just suddenly today I thought. Now, because this guy Ojas wants online only. He's not able to travel. Okay. So now that means for you have ample of time. So now the only left out guy is now for Vinith, all doubts. So I'm thinking like to prioritize his doubts now, because in 1 month or hardly this month, and by this, August starting also, I will cut off everything so that he doesn't require, like, I will finish off all the work for him. So just this thought came into my mind. So maybe I will not keep it on Wednesday, and I will just do all doubt solving, because then only I'm able to sort out, because his doubts are like never ending. So I have to give then more and more and more and more time only. But last 2 3 weeks I have to do all these things. So after that he will be out of the system. Then anyways, I can sort out all, because see, once this mid-August comes now, this August people will be out. Then it will be very easy for me to uh, sort out what, even if you have any doubts, questions, or whatever subjects is left out for you, I will be covering up all those. So next 2 3 weeks I'm thinking to focus on all his doubts.
So
Okay.
only for this month, for this month, you will be prioritizing online.
Yes. Yeah.
So,
Yeah.
because I'm only comfortable in offline mode only.
So I will keep it offline. Now, even now, I did not call you. You only said classroom training, right? You only said online, right?
Yes, sir.
Okay. Okay, then I'll
So
stop.
because I'm just reading all equity also. I had some doubts over there as well.
Okay, yeah.
That's why. Yeah.
Okay then. Yeah. Okay, then I'll stop now.
Yes, sir.
Okay.